Hello everyone, welcome back to another video. If you're new to this channel, my name is Farhan and I help accounting students like you ace their exams. Today we have got a practice question which requires us to prepare the trade receivables ledger account, the trade payables ledger account, and the inventory ledger account. Now, if you are taking your Cambridge exams from a different country, the trade receivables and the trade payables are also known as accounts receivable and accounts payable. Now, what we are going to do is prepare this ledger accounts and then find the missing numbers for credit sales. We'll find the missing numbers for credit purchases and the cost of goods sold, and then we'll solve this question along the way. So you can see the question on the left-hand side of your screen, and on the right-hand side, we've got all the workings, which I'll go through and explain to you step by step. What I need you to do now is focus and follow through for an excellent understanding. With that being said, let's begin. Gwen failed to keep a proper set of accounting records for her retail business. At the end of the financial year ended 31 August 2016, the following information was available. So here we are given the summary of bank account for the year ended 31 August 2016. We are given the receipts from credit customers, which is referring to money that we have received in our business bank account from our credit customers to whom we have sold goods in the past on credit. We have also got cash sales, which we have deposited in our bank, and that is $4,000. We also have amounts for payments, which we have made to our credit suppliers, who are our current liabilities. We are given some additional information with regards to the opening and closing balances at the beginning of the financial year on 1 September 2015 and at the end of the financial year on 31 August 2016. We are also given the trade payables and inventory balances. You can see in the second additional information, we are given some extra information which we need to consider in solving our question. So let's answer the first question, which requires us to calculate the net sales revenue for the year ended 31 August 2016. Now, when we think of net sales revenue, it can be calculated by adding the credit sales together with the cash sales, and then we subtract any sales returns that we've got in our business. Now, to find the credit sales, we need to prepare the trade receivables or the accounts receivable ledger account. And here I have prepared this account using the T column format. Okay, so let's start with the first account, which is the trade receivables. Now, when we think of trade receivables, it is a current asset for the business, right? The reason this is a current asset is because we have some economic benefits with these credit customers. And the reason we have economic benefits with these credit customers is that in the past, we have sold goods to them on credit, and these customers have made a promise to pay us back in the future. All right. Now, assets, when they increase, we always debit them. This also means the opening balance of assets must always be on the debit side. So here within the T account or the ledger account for trade receivables, we have included the opening balance on the 1st of September 2015, which is balance brought down of $25,000, and that is recorded on the debit side. Then you take the closing balance for trade receivables at 31 August 2016, which is given to us at $35,000. That closing balance for assets must always be on the credit side of the ledger account, which is what we have done here. You can see on the credit side for the year ending 31st of August 2016, the closing balance, which is balance carried down, C/D for short, and that is $35,000. Now, our requirement in this question is mainly to find the credit sales, okay? So I've just highlighted that within yellow, and we will find out how to find this number, okay? Now, so during the year, based on the information given to us in the second paragraph, you will see that receipts from credit customers of $30,000. So when we are receiving money from credit customers, what is happening? What is the correct way to journalize it? If you receive money, we debit cash at bank, because cash at bank in itself is an asset account, which means our funds available in our bank account are going up. And when bank account funds go up, it means assets go up. And when assets go up, we always debit it. Simultaneously, we will credit the account for trade receivables, TR in short, which I've written here. The reason being, trade receivables are originally our assets, but once they have made the payment, they are no longer our assets, right? Which means assets are going down in value, and to reflect that reduction, we have to credit trade receivables. This means The ledger account of trade receivables on the credit side should show cash at bank as a cross-reference, all right, at 31st of August 2016, and that is $30,000, okay? Now, if you check the second additional information which is given to us, it's mentioning about credit note issued to credit customers during the year amounted to $500. Now, credit note is only issued by the seller. And in this case, the seller is us, assuming that we are Gwen, all right? So we are issuing the credit note to our customers and confirming the returns that have been already processed. The amount for that returns is $500. The correct terminology is either the return inwards or the sales returns account, right? So when there is a return that we get from our customers, what happens is that the customer doesn't owe us that money for the goods which they have already returned us. So whenever there is a sales returns, how can we journalize that transaction? To journalize the transaction that involves sales returns, we will debit the sales returns, all right? And we will credit the trade receivables account, again, because assets are going down in value, and when assets go down, we credit it. So this means that within the ledger account on the credit side, okay, we will show the sales returns of $500, okay? Now, how do we find this missing amount for credit sales? So what we have to do is add everything that we have got on the heavier side, which in this case, if you just glance through the ledger account, you will know it's the credit side. So you add everything that you have got on the credit side, which is 35,000 plus 30,000 plus 500, and that gives us $65,500, okay? So that gives us $65,500, which means now if you want to find the sales revenue, what you have to do is subtract the opening balance of 25,000 from 65,500, right? And that gives us $40,500, right? All right. Now, how do we find the net sales revenue? As we have discussed in the beginning, to find the net sales revenue, you add the cash sales with the credit sales, and then you subtract the sales returns. So what are my cash sales? So the cash sales are $4,000, which is given in the beginning of the question here. Cash sales which have been banked in, that is $4,000. Then we add the credit sales which we have derived, that is $40,500 based on our preparation of the ledger account, and then we subtract the sales returns of $500. So this leaves us with a final amount of $44,000 as the net sales revenue, okay? All right, so now let's move to the second question. Calculate the inventory purchased for the year ended 31 August 2016. And the third question, which requires us to calculate the cost of goods sold for the year ended 31 August 2016. So to prepare this, we have two ledger accounts this time, which we are gonna solve at the same time. And that is inventory and trade payables. Now, trade payables refer to the credit suppliers of the business, right? These are the people from whom we as the business buy inventory on credit, okay? So let's use the opening and the closing balances, which are given to us for trade payables. Now, the opening balance for trade payables at 1 September 2015 is $15,000, and the closing balance is $25,000 at 31 August 2016. So in the ledger account for trade payables, which in itself is a liability because we are obligated to pay the suppliers because of the inventory which we have bought from them on credit. So what do? So to record the opening balance of the liability, we record it on the credit side. So liabilities, when they increase, they're always credited. This means by default, the opening balance must be always on the credit side. So we start with the opening balance of the liability on the credit side, which is on the 1st of September 2015. And you can see balance brought down, which represents the opening balance, and that is $15,000. Then we have the closing balance, which is on the debit side, obviously, and that's going to be at the end of the financial year on 31st of August 2016, which is written as balance CD, balance carried down, and that amount is $25,000, okay? Now, based on the information given at the beginning of the question, we know that payments to credit suppliers were $20,000, okay? So when we make a payment to credit suppliers, how can we journalize that? So we debit the trade payables because liabilities are going down. We no longer have an obligation towards the suppliers because we have already made our payment. But how are we making this payment again? Using our funds available in our bank account, which in itself is an asset account. And assets are going down in value because you're utilizing the funds in your bank account. And when assets go down, we credit it. So we would be crediting the cash at bank account. So this means within the ledger account for trade payables, on the debit side, we have to include the cross-reference of the account as cash at bank. And that amount, as you can see here, is $20,000. All right? Okay, so now we have to find the missing amount for credit purchases, which is what you can see on the credit side highlighted in yellow. Okay, so how do we find it? Again, we assume that we don't have this number here to begin with, and we take a quick glance, we easily know that the heaviest side is the debit side. So we add everything on the debit side, which is to add 25,000 with 20,000. That gives us $45,000, which means the 15,000 on the credit side needs to be subtracted from $45,000, and that should give us $30,000 as the purchases we have made from our suppliers, okay? And you can see the relevant cross-reference in this case is the account for inventory, okay? The reason being, obviously, when we make purchases, your inventory goes up in value, right? So you debit inventory and you would credit the trade payables, given that you're buying on credit. So now let's look into the inventory account. So inventory, obviously, we understand is an asset account. No doubt about that. And we also understand that all assets must have an opening balance on the debit side and a closing balance on the credit side. So based on the additional information that is given to us, you can see that inventory on the 1st of September 2015 is $10,000, and inventory at 31st of August 2016 is $5,000. So this means that on the debit side, we would first record the opening balance at 1st of September 2015, which is balance brought down of $10,000. And then on the credit side, we are recording at 31st of August 2016, the closing balance of $5,000, which is balance carried down. Okay? All right. So based on the trade payables account, which we have just solved, we understand that our inventory that we have purchased from our suppliers was $30,000 in value. And we clearly understand that when we buy inventory on credit from our suppliers, we debit inventory, obviously because our assets are going up, and we credit the trade payables, obviously again because our liabilities are going up. So if we have to debit inventory, this means within the ledger account for inventory on the debit side for the financial year ending 31st of August 2016, you show that you have bought inventory from trade payables, which is the cross-reference you can see here, and that amount of inventory you bought was $30,000, right? Okay, now, so you can see on the debit side, I have recorded cost of goods sold of $375. So if I'm recording cost of goods sold of $375 on the debit side, what does that really mean? If I was to express this as a journal entry, this means that I'm debiting the inventory account by $375 and crediting the cost of goods sold account by $375. So this means that when I debit inventory by $375, my assets are going up in value. And when I credit cost of goods sold account by $375, I'm actually saying my expenses are going down. And when can this actually happen? Let's refer to the second statement that is given to us in the additional information with regards to credit notes. Now, the additional information clearly mentions that the credit note that we as a business issued to credit customers during the year amounted to $500. So this was the amount expressed in revenue or sales terms, right? But the gross profit margin on this was 25%. Okay. So let's do some calculations. So we understand that the sales returns or the return inwards is $500 to begin with. And the gross profit margin can be derived as the gross profit divided by sales, okay? Now, the gross profit margin is given to us as 25%. We already know the amount for sales for the specific inventory which was returned to us, and that was $500. And the gross profit is the missing figure which we look forward to solve using algebra. So it's pretty straightforward. So if you find gross profit, you multiply 25% with 500. That means the gross profit was $125. So if the amount of sales for this inventory was 500 and the gross profit was 125, that obviously means that the cost for this inventory must be 375, right? And the cost is what matters to us. So when the inventory was returned to us, our inventories are again going up in value. That is why we are including on the debit side this additional cost of goods sold of 375, okay? Now, we are looking for the missing item on the credit side, which is the cost of goods sold of 35,375, which refers to the cost of goods sold for actual sales that we have processed during the financial year starting 1 September 2015 and ending 31 August 2016. So how do we derive this? Again, let's just assume we don't have this, and you add everything that you have on the heaviest side, which is the debit side. And when you add everything on the heaviest side, which is the debit side, you get a total of 40,375. That must be the total of everything on the credit side. So if you subtract the closing balance of 5,000, which we have got, that leaves us with $35,375 to fill in the gap. And therefore, this can only be cost of goods sold, which refers to inventory that you have actually sold during this financial year, all right? And that is being accounted for in your net sales revenue, all right? Okay, so that's all for today's lesson. If you found value in this content, make sure to drop a like and subscribe to this channel, and also share this channel with your friends. Make sure to check the courses that are given in the description of my channel bio, and I'll see you in the next one.